My name is Benjamin Z. Miller, and I am the co-founder of Andesite Blue. Andesite Blue is a United Kingdom company that invests into the emerging market of Ukraine. We do this by offering a passive income bond that pays interest to our bondholders. Our bondholders are typically accredited investors, high net worth, or institutional investors. So in today's discussion, I'm going to give Benjamin Z. Miller's view on bond ladders and the economy. So I'm not offering financial advice. I'm not telling you what you should do. You should talk to your experts, your lawyers, your accountants, your financial advisors. I'm telling you my view. Now, I've got a lot of experience in finance, and I'm pretty sure I'm right, but I'm just going to tell you my view, and then you can discuss it with other people. So, right now, an investor that is trying to get passive income, bank CDs, they're not even worth buying. There's no point. You're not even getting a real rate of return. On a 5-year bank CD, this happens to be for the United States, but the same situation in the United Kingdom. You're going to get a 1.65% rate, and it's not even, you figure 1.5% on a 5-year jumbo CD where you're going to lock up $100,000 or pounds, and you're going to get 1.5%. And in the United States right now, the reported inflation rate is 7%. It just is not a real smart strategy. I'll just put it that way. Government bonds, all of the government bonds, they're all paying very low yields. You pick any government bond and it's a low yield, practically. Here's, for example, gilt yields in the United Kingdom. Nothing going on there. No advantage in buying those. The relationship is, as the interest rates rise, bond prices fall. But I want to go into a little bit more detail on how that works. So how does the duration actually affect the price of your bonds? This is important because a lot of new investors, maybe they don't understand this, they don't think about it. If you've got a short-term bond, say you have a bond that's only for 2-year term, say it's a government bond, it's a 2-year term, and let's say that the interest rates increase by 1%. That bond is going to decrease in price by approximately 2%. For every 1% increase or decrease in interest rates, a bond's price will change approximately 1% in the opposite direction for every year of duration. So if you've got a 6-year bond and the interest rates go up 1%, the price of that bond is going to decrease approximately 6%. If you have a 20-year bond and the interest rates go up 1%, the price of that bond is going to decrease by approximately 20%. So longer-term bonds are far more impacted by swings in interest rate. So there's a concept called a bond ladder. In a laddered portfolio, you take maturing short-term bonds and then you reinvest into bonds at the ladder's long end, which typically offers higher yield. And that can sometimes be an advantage in a rising interest rate environment. With the current situation, I think if an investor is holding long-term domestic bonds, US or UK bonds, say they've got a 20-year or a 30-year or a 10-year bond, I think it is very important to sell those because the interest rates are projected to go higher. And when that happens, the price of those bonds is going to go lower. So if you get out now, you're not going to lose as much money if an investor does that. If I was holding bonds that were government bonds, I would sell them, and I would sell them very quickly if they were long-term 20 or 30 or 10-year bonds. It's not as damaging if you've got just a 1 or a 2-year bond, but a good strategy is, in my view, a good strategy is to sell those long-term bonds, get the cash out, and then if you need the income, don't look at domestic bonds, because you're not going to get a real rate of return even hardly on most domestic bonds once you factor inflation in. Better strategy, in my view, is you sell the long-term domestic bonds, then you take that money and invest into an emerging market bond that offers a higher rate of return, so that you can potentially get a real rate of return instead of just have it all gobbled up by inflation. Now, whether you buy government bonds or you buy emerging market bonds, that just really is your choice. I mean, some people, they love those government bonds because it has the certainty associated with it. They say that the emerging market bonds can sometimes be, it depends on the situation, each investor. But if you would be interested in learning more about the types of bonds that we offer, that I believe will be more successful in protecting from wild price swings, because our bonds have lower duration. We offer a 3-year and a 5-year bond. And if you're currently holding, if an investor is currently holding long-term bonds, and it would be interesting to look at that to see if maybe andesite blue would be a good solution, because we've got higher rates of return, we've got shorter terms, and that should work well in a rising interest rate environment. So I hope you found this helpful. Please do not hesitate to reach out to us at andesiteblue.com. I'd be happy to speak with you or some of the other team members. Thank you so much.